In today's episode, we are going to discuss an extremely important topic, and it's how to hedge inflation in your income in retirement. What can you do to make sure that your income doesn't wind up becoming not enough in retirement due to inflation? Let's roll.
Welcome to the Safe Money Retirement Show with your host, certified financial fiduciary, Tim Wood. Tim is a retirement and income planning expert, best-selling author of Safe Money Retirement, Your Game Plan for Success, member of the exclusive Ed Slott Master Elite IRA Advisor Group, and founder of SafeMoneyRetirement.com. Tim uses an education-first approach with clients nationwide to ensure they understand their choices in planning their own safe money retirement. Tim focuses on wealth management, retirement income, tax and long-term care planning, and asset protection and growth strategies. And now, from the Safe Money Retirement Studio in Johnson City, Tennessee, your host, Tim Wood.
Inflation. We all know it's a dirty word, and let me tell you, in retirement, it can absolutely be a killer. You have got to make sure, obviously, that you've got enough income when you retire, but you got to make sure you've got enough income in 10 years if inflation keeps going higher, if it gets higher again. What about 20 years? What about 30 years? What can you do now to hedge future inflation in your income, specifically in retirement in your income? We're going to discuss that and take a deep dive. First, if you don't already have a copy of my book, Safe Money Retirement, Your Game Plan for Success, get your copy right now. We will send you a copy absolutely free. No obligation, no cost. It's our way to help people understand what their options really are in retirement. And in this book, it's going to go into depth about what you can do to help hedge inflation in your income in retirement. So get your free copy. You can get it right from our website, safemoneyretirement.com, or give us a call, 833-413-SAFE. That's 833-413-7233. All right, so let's get into the nuts and bolts of this. So the very first thing that we do with every single client is we want to make sure that you've got enough income for when you retire. We're going to just touch on this really quick because we're talking about inflation, which is more of a long-term thing, but just really quick. The very first thing that we do is we make sure you have got enough income when you retire. Well, how do we do that? We look at any income sources you may have already set up, Social Security, any pensions, any rental property, any spousal maintenance, anything that's paying you an income. We look at that right when you retire. What's that going to be? And then we look at your expenses and see if there's a gap. Well, if there's going to be a gap, we need to get you a plan that's going to fill that gap. So that's step number one. That's the very first thing we do with every single client. We make sure you've got enough guaranteed income. We don't want you living on if-come at retirement and hoping you'll have enough and just using money out of your account and praying to God you don't take too much out. So that's the first thing we do. We get you guaranteed income for life that's going to cover your bills. But now, what can you do if inflation keeps going and if it gets worse? What can you do to help hedge that inflation specifically in your income in retirement? Well, here's what we do. I just told you about the plans that we get you into to cover the income when you retire. We also typically talk to people about setting up some smaller income plans. And when I say smaller, it depends on the person. It could be a $20,000, it could be a $50,000, it could be a $100,000, but smaller income plans that we're not going to turn on at retirement. We are going to let them continue to compound and grow year after year after year after year that you can turn on at some point in the future. There are plans that just continue to grow. They don't stop growing in their income value. And what that allows you to do is then at some point in the future, you can turn them on. And then when you do turn them on, that's going to provide another guaranteed income source, not an if-come source. So that's going to get you the ability to allow something to continue to grow, continue to grow, continue to grow for years and years and years until you need it. So for example, here's one actual client example. I've got a client that's got 7 of these. Got him set up for when he first retired, got him a nice big plan that covered his income so he could retire. Great, done. Then we actually did 7. He did $50,000 plans. So he did 7 of these smaller plans. So he basically took $350,000, we broke it into 7 $50,000 plans, and each one of these plans is in a guaranteed lifetime income plan, but they're all 7 separate individual plans. Now, why do we want to do that? When you read my book, you'll read about the ladder strategy. That's what this is. So you get the first step of the ladder, that's getting you into retirement. Well, at some point, you're going to need a little bit more money. You can turn on, for example, that client I just told you about, has got 7 of them. He can turn on 1. Well, that's going to give him a little bit more money from that, whatever that 50,000 has grown to, but the other 6 are still growing. Few years later, you need a little bit more money. No problem. Turn on the other one. You still got 5 growing, and you literally just continue to let them continue to grow. And any of those that you don't turn on and you wind up passing away, the good news, every single penny in the account goes to whoever you've named as your beneficiary. So this allows you to have a hedge specifically against inflation, in your income. So that's what we're talking about, is actually having a hedge to be able to not have to worry about things coming up to where they cost more. The cost of living has gone up and everything, and you don't have those kind of raises in your Social Security or in some pensions have cost of living increases, but it may not be keeping up. This allows you to have guarantees in income that you can put into a plan, guaranteed growth for a set number of years, let it go, and then whenever you're ready, turn them on, and you turn them on incrementally. Now, some people don't have the ability to do multiple plans. That's fine. We still try to get at least a couple of those going, because at some point in the future, you're going to need a little bit more money. Maybe, God forbid, it's when someone goes into long-term care and you need more money. Let's say that's a situation that might happen with that client that I mentioned that has 7 of those. He's actually already turned on 2, so he's still got 5 growing. God forbid there's a long-term care situation and he needs significantly more income. He could turn on the remaining 5 tomorrow if he wanted to. So there's no set time that you're going to turn these on. They just give you that extra guaranteed income for whenever you need it, for whatever you need it. Because right now we're talking about inflation, but long-term care or healthcare cost is a major deal. That's another major concern for people. And knowing that you've got the ability to turn on extra income that is guaranteed income, that's the big difference here. Guaranteed income that you cannot outlive no matter how long you live. Knowing that you've got these plans out there that are just continuing to grow and you can turn on at some point, and again, if you don't, all that money goes to your beneficiaries, but having that allows you to have a lot of peace and know that you can overcome inflation in the future if your cost of living in Social Security or pensions or anything else doesn't cover the rising cost of goods and just living. Having those plans allows you to have that hedge in inflation in your income in your retirement. Golf and retirement can be a lot alike. I am having a terrible time this round and it has been rough. And you can have those days in retirement, those days when you get up and you see the market has tanked and you feel it in your stomach. And you've worked 20, 30, 40 years to save what you need for retirement. Well, what if you could absolutely 100% protect what you've saved and not have to worry about market losses anymore? What if you could have enough income for you and your spouse for the rest of your life, no matter what? Hi, I'm Tim Wood. I'm a certified financial fiduciary, and I wrote Safe Money Retirement, Your Game Plan for Success, to give you a guide map in order to protect what you've worked your whole life to save. See, my father lost over 75% of his retirement in his first 4 years because the market crashed. Don't let that happen to you. Download your free ebook now and get the answers that you need. In today's case file, we're going to look at the story of David and Carrie. They were awesome. They came in, they were in their mid-60s, still working. They were planning to both work until 70. And they wanted to make sure that what they had saved for was going to be protected and could still grow. they were both really concerned about a potential market crash in the near future. I mean, they're thinking there's going to be one in the next year or two, which they could be right. So they wanted to make sure that their retirement plan, their retirement money they had saved for all of these years was protected in case there is a major market crash. Now, of course, like I do with everyone, I looked at their income first. They didn't have any income needs. They both were going to each get over $50,000 a year in Social Security when they retired at 70, and they both had pensions that was going to pay them each over $50,000. So they had plenty of income, no income concerns at all. What we needed to do is we needed to get them into a plan that protected what they had and gave them excellent chances for growth. So what we did was we got them into one of those hybrid plans people have heard me talk about that allows you every year to reallocate and choose how you want your money to grow. So every single year they can choose between, I want my money to grow in a fixed rate, and here's what it is, and you know what it is, and it's guaranteed for that year, or I want it to grow based on the S&P or the Economic Cycle Factor Index or the Daily Risk Control Index or the Morgan Stanley. There's a bunch of different indexes, or a mix of some. For example, I have multiple of these accounts myself, and I usually do a little bit in the fixed and then spread out over different indexes because that, in my opinion, that gives me the best chance for growth. But it gives the clients every single year, they can choose how they want their money to grow based on how they feel. Now, do they ask us our opinion and what do we feel is going to happen in the market the next year? Of course. The great thing about these plans is it allows the client to be in control of their own money. You can choose, how do you want your money to grow this next year? Do you want it to grow based on a fixed rate? Great, let's put it in the fixed rate. Do you want it to grow 100% based on the market, so that gives you the absolute best chance for growth? Let's go in that way. Or you can do a mix of the two. So that's what we did for them, got them into a plan. They left extremely happy knowing that the money that they had to have for retirement was protected and that they never had to worry about a market loss completely decimating their retirement plan. Now, how can this work for you? Maybe you're in the same type of a situation. Maybe you've got your income totally taken care of and income isn't even a thought for you in retirement. Great, congratulations. But what about the money that you have saved? What amount of that do you want to make sure is not going to be lost if there's another major market crash? What amount do you want to make sure is not going to be lost? That's what you need to think about. Now, y'all, many of y'all have heard me say this before. One really good rule of thumb is whatever your age is, that's a pretty good percentage to have protected from losses. In other words, if you're 70 years old, somewhere around 70% of your retirement savings should be protected from market losses in case there's a major market event. So knowing that, we can sit down with you and look at what you've got. First of all, again, we'll make sure that your income is taken care of. If it's not, we will talk about that first. Get your income taken care of first. But after that, then we will look at growth plans, and we need to determine, how do you want your money to grow? Do you want your money to grow based on just a fixed rate and never worry about the market index? Well, we can do that. We can get you into a plan that's going to grow at a fixed rate for a set number of years. Set it and forget it, never have to think about it. Absolutely, we can do that. Or we can get you into a plan that allows you to reallocate every single year, just like they did. And every year you can choose fixed rate, market index rate, a mix of the two, and you can change it every single year. So it's dynamic and it allows you to choose how your money is going to grow. And of course, in these plans, it does give you some liquidity. The plan specifically I was talking about for them allows for 10% every year they can withdraw. Unless there's some sort of a long-term care situation or a terminal illness, then they have access to all of it. But that's a side note. What you need to think about is, how much do you need to make sure that you have? Get it into a product that you know is not going to have any losses. If there's a major market event, then you know that you also can live your own happy, safe money retirement. Well, I'm about out of time, and I would like to thank you for listening to the Safe Money Retirement Show. If you're serious about your financial future, give me a call and together we'll get your retirement savings on the fast track to accumulate while reducing exposure to market loss. Thanks for listening, and until next time at the same time, I'm Tim Wood reminding you to stay safe so you can step into a secure future.
You've been listening to the Safe Money Retirement Show with your host, Tim Wood. Find out how to contractually guarantee that your income in retirement is guaranteed lifetime income and not if-come. Avoid any future market losses, plan for the potential of long-term care, and make wise tax planning choices so you can have the retirement that you deserve. Call us now for your free copy of Tim's best-selling book, Safe Money Retirement, Your Game Plan for Success. Call 833-413-SAFE. That's 833-413-7233. Or log on to our site at safemoneyretirement.com for more information or to request your free book. Thanks for joining us. We'll see you online at safemoneyretirement.com. The preceding information does not represent tax, legal, or investment advice. Obviously, by contacting us now, you are only taking the first step toward protecting your retirement. No information presented today should be acted upon without meeting with a qualified licensed insurance professional. It's important that you read all insurance contract disclosures carefully before making a purchase decision. Interest and other guarantees in annuity contracts are subject to the claims-paying ability of the insurance carrier that issued the contract. The tax consequences of annuity income should be considered with the help of a licensed tax professional. Rates and returns mentioned on this program may vary based on state availability and are subject to change without notice.